Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the US-UK Tax Treaty and how it impacts pension plan income. Let's go through the basics as we always do. The US taxes individuals on their worldwide income, right? Let's use Jim. Jim is a US citizen. He lives in country B. All of his income is being generated in country C. The US is still going to tax Jim on all of the income he earned outside of the US, because it's not based on his residence, it's based on worldwide income and citizen-based taxation rules. In addition, Jim's going to be required to report his global assets, accounts, and investments to the IRS on a broad range of different forms you probably are familiar with at this point. FBAR, Foreign Bank Account Reporting, FATCA, Foreign Account Tax Compliance Act, Form 8938, Form 8621, etc., etc. The U.S. enters into income tax treaties with various countries depending on how well they're getting along and who wants to cooperate with the U.S. There are various different tax treaties. Your most common, the income tax, double taxation bilateral tax treaty. You've got the FATCA agreements. You've got, which are called IGAs, intergovernmental agreements. You've got totalization agreements for Social Security contributions, so they don't have to double up on that. When it comes to the UK and the US, they have a very robust section or article 17 and 18 on pension plans. Most country tax treaties have, maybe a little blurb or two, but between the US and the UK, they have a very comprehensive pension plan treaty provisions. So the two main questions we normally get revolve around whether it's exempt and the 25% lump sum distribution. So generally the rule is the country of residence gets to tax the income. Jim lives in the US now. He's receiving annuity payments from a pension plan in the UK. The US gets to tax that income because Jim is a resident of the US. Now there are exceptions to that rule. If the pension plan is exempt for Jim, if Jim was a resident of the UK, then the US does not get to tax that pension plan income because that's the exception. The pension plan is exempt in the UK if Jim had resided in the UK or was residing in the UK now. Therefore, the US cannot tax that income. But the main one we get is about the 25% lump sum distribution. Under the UK tax rules, Jim can take a 25% lump sum distribution tax-free on income from the pension once he reaches the age of retirement. Does the US tax that? I know you don't want to hear this, but generally they do. If you look at some of the rulings and whatnot, the IRS doesn't seem to approve of it being tax-free in the US. Here is why. In order for it to be tax exempt in the US under the treaty, it has to be a lump sum distribution. Lump sum distributions would not be taxable in the US. So people say, well, it's 25% lump sum distribution. The treaty doesn't say that, and the way I believe the IRS looks at it is like this. Lump sum distribution presumes you're receiving the full amount, a lump sum. So, if your administrator of the pension said, Jim, do you want to take annuity payments monthly, or do you want a lump sum distribution? That would presume that Jim is going to receive the full amount, right? It's not, do you want to receive an annuity, or do you want a 25% lump sum distribution now, and then you receive annuities later? But it is not a frivolous position, at least my belief, to claim that it's exempt from tax in the U.S., even if the IRS doesn't want to agree. Why? Because nowhere in the tax treaty does it say a lump sum distribution means it has to be a 100% distribution. Just because it starts out as a lump sum distribution, moves to an annuity, wouldn't necessarily per se make it not lump sum. So there's definitely some meat there. I don't think it would be frivolous to take that position. You just have to keep in mind the IRS may come back and say it's taxable, so you want to make sure you have some liquidity to pay any tax that could be due on that income. One good part about the tax treaty is the contributions to foreign pension plans. So most treaties do not exempt foreign employer contributions into a foreign pension plan. from U.S. tax. So Jim's working in a different country. His employer contributes $15,000 of his salary to defer it into a pension plan. That $15,000 is going to be included on the U.S. tax return under the U.S.-UK Tax Treaty. There is an exemption for employment-borne pension plan income. In other words, if Jim works for a UK employer and that employer is putting or contributing money into a UK pension plan approved, then under US tax law, when Jim files his US tax return, he can claim a deduction of that contribution the same way, for example, he would have done it for 401k. The main thing to keep in mind is the deduction cannot exceed what the deduction would have been had Jim been working for a U.S. employer who was contributing to his U.S. pension plan. When it comes to pension plans in the UK, there are lots of moving parts: FBAR, FATCA, income, PFICs, etc., etc. If you're out of compliance, don't worry about it. Don't be scared off by most of the garbage you read online. There are various IRS amnesty programs you can use to get into compliance, voluntary disclosure programs, streamlined filing compliance procedures, delinquency and reasonable cause. Which one you apply for, which one you qualify for, will be based on each person's facts and circumstances using what's referred to often as a totality of the circumstance analysis. We have lots of free information available on our website, goldinglawyers.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.